Hello, ladies and gentlemen. We start this week with the 5-year note, which is the chart which worries us most. It closed at 279, which is the highest level in during this move. It is, as we warned last week, now in a trend. It's overbought. It could easily slip back towards 267, 268. But it looks like the next big move is to go to 3. As this is the futures chart, which is a continuation chart and therefore not as good as the yield chart, but as you can see, this weekly close is very bad. We could easily have some move back in the early part of next week before we roll over again. It just is brutal. The market has decided that inflation is back, and as a result, the Fed will achieve its inflation target, and the yields will be somewhere around 3% before they normalize. So there is another 20-30 basis points in this move to the upside. If we look at the 10-year note, it closed the week at 295, which is the highest level since the move from the lows. New record high close. There seems to be very little doubt that it's going to go and test 3% at some stage, and 3% will be the magic level where equities will start getting affected. Anything above that and equities will have a bit of a scare, but it will be a scare because anything below, I would say 5%, still indicates that inflation is contained, and therefore equities could actually benefit in the long term. This is a one should not be trading anything but 10-year notes. Any move back into the 280s is going to be a wonderful buy for options to the upside. 3% in our view is almost guaranteed in the 10-year note sometime in the next couple of weeks. The 30-year bond, which we see here, is also slightly under pressure, but nowhere near as much as the 5s and 10s or the 2s. The yield curve is flattening. We have bonds trading at 314. 320 is the level that we should be careful of. When the bond reaches 320, it's time to get off the shorts in futures. We think it's going to be very hard for the bond to break this level. It will try, fail, come back quite deeply, probably fill this gap, and then probably go again. But in any case, it is quite clear that the trend for short interest rates, anything between 2 and 10 years, is higher and will be much higher than the 30-year note. This is the weekly chart of TLT. It closed right on the downtick. There seems to be little doubt that at some stage it'll trade quite a bit lower, probably 115. 115 is going to be the very, very important level that contained it basically since 2015. If we break 115, all hell is going to break loose in terms of equity valuations, and volatility is going to go through the roof. The reason why we don't believe that bond yields will make it through 320 is because volatility is not giving you any cause to be concerned. If you enlarge these last few trading weeks, we see that it's actually quite well contained, and it's bouncing off this very important level around 1455. We think it can probably break it and come back down towards 1275, 13, which will be a wonderful long-term long, but in any case, you can definitely start buying it around 14.50 for moves back up into the 25s at some stage. As far as equities are concerned, the weakest market all week has been actually the US market. Europe has been quite bid as a result of the dollar gyrations. We are not bearish equities. We think there will be one more move up towards 2800 in the next few days. Earnings are very good. They are easily beating the consensus, and we think as soon as we get one or two big tech giants confirming, we will have a move that takes out these previous highs and gets us up to at least 2750, if not 2800, before the gravity pull of the bonds reasserts itself and we come back down towards 2600. We are now in a 2600 2800 range, I would say, and we might as well trade that range. As far as NQ is concerned, this actually is slightly more troubling than ES. We really must stay above 66.15 over the course of the next couple of days. Otherwise, all bets are off, and we probably retest the 200-day moving average, which is all the way down to below 6,400, or it will be at 6,400. This is the most dangerous market. If we decide that we've completely lost the leadership of NQ, then all equity markets in the States are in big trouble. That's why any close below 66.15 early next week is going to be very troubling, and we shall watch it like hawks. Conversely, this is DAX. It is now at its four weeks on the trot up, and it is testing the very important 12,650 level. If we can't break 12,650, we have quite a bit of downside, probably all the way below the lows around 11,726, and that is the danger in the DAX. So what we would do is we would let it close above 12,650 for a week, and then we will be quite confident that it's going to squeeze up towards 13,600. At the moment, it's just too dangerous to play, and we don't want to get caught. So really, European markets are looking far better than US markets. So if bullish, buy Europe. If bearish, sell the United States, especially tech, which will probably be the tell for the move in everything early next week. Please also concentrate on the European fixed income markets. Bobble closed the week. This is a weekly chart, basically right at the highs, around -2 basis points. It has quite a bit of room up to go to all the way up to 13 basis points on these weekly charts. At some stage, both the Bobble and the Bund will trade 2%. That is something which is inescapable. When the market gets convinced that we are close to the rate hike time in Europe, it'll be a very, very quick and swift move. Something like that happened here. We went from -47 to 0 just about in 4 weeks. Well, this is going to be of the same order of magnitude. We are going to go from 0 to 80 in a week probably. So risk reward says be very, very short of Europe. Do options. You can do Bobble options, you can do Bund options. I would leave the Italian bond alone for the time being until things become clearer there, but certainly Bund and Bobble from negative will go quite massively higher in in the next few months. The risk reward is all on the upside in yields, and options is the way to play it. A quick word about the Bund. The Bund on the weekly charts can easily, after a couple of days of faltering around here, move all the way back up to the highs around 78 basis points. That to us is a high likelihood play, and options would again be the best way to play it. It is almost certain that the Bund will trade north of 75, just as the 10-year note is testing 3%. For anyone who still has doubts about why we are in such a bear market in bonds, well, just look at DBC, just look at commodities. This is a picture-perfect bull market. We're not saying it goes straight up from here. It probably comes back and retraces along this line for a few days and then makes another move up. This is textbook bond bear market territory. If now one looks at a weekly chart of DBC, one can see that it has indeed broken out above the previous highs. It closed above the previous highs. It's very close to the upper Bollinger Band, indicating that we will have indecision for a few weeks before marching on. It is certainly something which is turning this market within a few weeks, or even 2 or 3 months, will be ready to do a moonshot up towards 20. And here is DBC over SPY. As you can see, it keeps on closing well below 1571, which was the previous area of interest. This will be, when it starts going, we think it goes all the way down towards 12.5, 13, this longer term support level. The 200-day moving average is now firmly negative, so is the 50. We think over the next few months, certainly commodities are to be favored over equities. And so we turn to our biases for next week. Still put spread, still selling 5s and 10s. They still have at least another couple of points to go, i.e. to 3. After 3 we will become uncertain and hedge. Bunds and Bobble, by far the best short. They will trade over 2% in the next few months. At some stage, the ECB will have to start raising rates. Whether that is the second quarter or the third quarter of 2019 is absolutely irrelevant. It's a train which is in composition, and when it leaves the station is rather immaterial to us. If we have to pay away a few pips for a few months, that is not something which worries us at all. We will just be very happy to be on board when it finally leaves the station. Commodity prices, they have basically they are leaving the station. SPX, we're still looking for this break towards 27.30, 27.50 into the end of earnings, simply because we are quite we are producing some excellent results. At some stage, bonds will stop going up. As soon as bonds stop going up, the SPY will just fly, and in a couple of days it will reach those targets. We just wouldn't be very worried about NQ, which should perform on the upside if it breaks that level we indicated of around 66.15. So we'll put it in here. 66.15 is the be all and end all. Below that, and we are wrong, and we probably don't see this squeeze up to 27.30, 27.50. VX, as we indicated, if it comes anywhere close to 13.50, and 14.50 is where we start, it's a great time to buy some call options on VIX. The DAX, we still prefer the DAX to the US markets. We think it might get into the high 1200s. If it breaks and closes 12,650, we will be most happy to own it for several weeks. DX, it's just basically killing everybody. It's going sideways. We will forget about it for the time being. It is more likely to do head fakes in both directions than a sustained trend at this moment. Thank you very much indeed, and tweet you on Monday.